Hi, this is Professor Geeta Shah going to teach you Chapter 6. Chapter 6 is on the theory of tariffs and quotas. After finishing this chapter, you will be able to draw a supply and demand diagram and use it to illustrate consumer and producer surplus. You also will be able to draw a graph that shows the effects of tariffs and quotas on prices, output and consumption. You will be able to explain in words and with a diagram the effects of tariffs and quotas on resource allocation and income distribution. You will be able to differentiate effective from nominal rates of protection, and you will be able to list and discuss at least 3 dynamic costs of protection. Introduction: Tariffs and quotas. This chapter and the next chapter provide an introduction to the theory and policy of tariffs and quotas. This analysis is called commercial policy. The inefficiency and expense of tariffs and quotas to protect industries and jobs are apparent once direct costs are measured. Analysis of a tariff. There are numerous barriers to trade. Some are obvious, transparent, and others are hidden, non-transparent. Quotas, direct limit on imports, regulate the quantity of imports. Tariffs, indirect limit on imports, impose a tax on imports. Analysis of tariff continue. Tariffs and quotas encourage consumers to switch to relatively cheaper domestic goods or to drop out from the market. Tariffs and quotas also encourage domestic producers to increase their output as demand switches from foreign to domestic goods. This chapter is a partial equilibrium analysis of the effects of tariffs and quotas. Considers only their impact on the industry on which they are imposed rather than their economy-wide effects. Consumer and producer surplus. There are 2 key concepts in the analysis of impact of tariffs: consumer surplus and producer surplus. Consumer surplus is value received by consumers in excess of the price they pay. Can be measured only if the demand curve is known. Producer surplus is the value received by producers in excess of minimum price at which they are willing to produce. Can be measured only if the supply curve is known. Figure 6.1 shows consumer and producer surplus. You can see that each point on the demand curve shows how much buyer values the good. In other words, each point on the demand curve shows buyer's willingness to pay. And market price shows actual amount paid by buyer. Area of consumer surplus falls below the demand curve, above the market price. You can see consumers are happy because they pay less than their willingness to pay. Each point on the supply curve shows seller's cost. And market price shows actual amount received by seller. So area of producer surplus is below the market price, above the supply curve. And you can see here producers are happy because they make more than their cost. Prices, output and consumption. Assume there is only one price for a good, world price, PW. Foreign producers are willing to supply us with all the units of the good we want at that price. Figure 6.2. Domestic supply and demand for the imported goods. You can see that at the price PW, domestic supply is Q1 and domestic demand for the good is Q2. So, the difference between Q1 and Q2 is the quantity of imports at the price PW. Again, the difference between Q2 and Q1 is the quantity of imports at price PW. Now, assume government imposes tariff of amount T. Importers will still be able to buy the good from foreign producers for PW, but they will have to pay the import tax of T. The tax is subsequently tacked onto the price to domestic consumers. Price to them is now PW plus T equals PT. So PT is the price for consumers after tariffs. The consumption of imported good subsequently decreases because of the increase in the price. Figure 6.3 shows the effects of a tariff. Look at here. Each point on the demand curve shows buyer's willingness to pay. In another word, how much buyer values the good. Each point on the supply curve shows domestic supply and their cost. Here, this country is importing this good at price PW. So look at the graph. At price PW, the area of consumer surplus is below the demand curve, above the market price. So it is equal to A plus B plus C plus D plus E plus F. And producer surplus is area below the market price, above the supply curve, G. Now, government imposes tax. And with the tax, the price of this imported good increases from PW to PT. At price PT, increase in the price, you can see consumer surplus decreases and becomes E plus F. And with the tariffs, producer surplus increases and becomes A plus G. C is the tax revenue from tariff will go to government. And because of restricting import, you can see deadweight loss shown by B and D. In summary, tariffs cause the domestic price to rise by the amount of the tariff. Domestic consumption falls. Domestic production rises. Imports fall. Resource allocation and income distribution. Tariffs have more subtle effects than just a rise in prices and a fall in imports. Inputs in domestic production. Increased domestic production requiring additional resources of land, labor and capital to be reallocated from their prior uses into the industry receiving protection under the tariff. When the price changes, consumer and producer surplus changes too. Resource allocation and income distribution continued. Deadweight loss, destruction of value that is not compensated by a gain somewhere else, area D, is this type of loss. Efficiency loss, another deadweight loss which occurs on the production side, area B, is this type of loss. Summary. The net effect of the tariff on national welfare is gains to producers, gains to government, and losses to consumers equals A plus B plus C plus D minus A minus C equals B plus D. So you can see with the tariffs, domestic producers and government are better off, but domestic consumers are worse off. Table 6.1 Economic effects of the tariff in figure 6.3. Variables, free trade, post-tariff. First of all, we will learn about all these variables in the free trade concept. If there is free trade, then price to consumers will be PW. Domestic consumption will be Q2. Domestic production will be Q1. Imports will be Q1 times Q2. Consumer surplus will be A plus B plus C plus D plus E plus F. Producer surplus will be G. Government revenue, 0. Deadweight consumption loss, 0. Deadweight production efficiency loss, 0. Now you can see the effects of tariff on the welfare of economy. With the tariff, price that consumers pay will increase from PW to PT. Domestic consumption will decrease from Q2 to Q2 star. Domestic production will increase from Q1 to Q1 star. Imports will decrease from Q1 Q2 to Q1 star Q2. Consumer surplus will decrease from A plus B plus C plus D plus E plus F to E plus F. Producer surplus will increase from G to G plus A. Government revenue will C. Deadweight loss shows D. Deadweight production loss shows B. Tariffs reallocate income from consumers to producers and government. They also create deadweight losses, one on the consumption side and one on the production side. A comparison among tariff rates. The Doha Development Agenda of the World Trade Organization, we call it WTO, is focused on the trade problems of developing countries. At issue for many developing countries are the levels of tariffs and other industrial country barriers that block access to agriculture, clothing, and textile markets. However, developed nations often have highest tariffs in agriculture, textiles, and other labor-intensive products. The very products developing nation would like to export. Comparison of tariff rates continued. Industrial countries, the World Bank, and the WTO have argued major problem facing developing countries is the relatively high level of protection among themselves. High tariffs limit the country's ability to sell into each other's markets and consequently their ability to follow their comparative advantage. Figure 6.4 shows average tariff rates from 1986 to 2010. You can see the average tariff rates is lower in the high income countries than the lower income countries, but you can see since 1986 average tariff rate has decreased. Other potential costs. A tariff may have effects that are less predictable and harder to quantify. Retaliation by other countries adds to the net loss of a tariff by hurting export markets of other industries can escalate rapidly. Innovation. Tariffs reduce competitive pressures on domestic firms and thus their incentive to innovate and improve the quality of existing products. Other potential costs of a tariff. Rent seeking. Any activity that uses resources in order to capture more income without actually producing a good. As for example, firms hire lobbyists to maintain tariff protection. Political systems that do not easily provide tariffs are more likely to avoid rent seeking. The large country case. Economists distinguish between small and large countries in analyzing tariffs. Large country, one that imports enough of a particular product so that if it imposes a tariff, the exporting country will reduce its price of the good in order to keep its share of the large country's market. In theory, large countries can improve their national welfare by imposing a tariff as long as their trading partners do not retaliate. Figure 6.5 shows the tariff in the large country case. Here we can see that with the tariff, the price is PW plus T. But these exporting countries want to continue business with this large country. So they keep the price below the PW star. So as they decrease the PW price to PW star, they will lose less exports. Effective versus nominal rate of protection. The amount of protection given to any one product depends not only on the tariff rate but also on the tariffs on the inputs used to produce the good. Nominal rate of protection. Tariff rate levied on a given production. Effective rate of protection. Nominal rate plus tariffs on intermediate inputs. Value added. Price of a good minus the cost of intermediate goods used to produce it. The contributions of labor and capital at a given level of the stage of production. In sum, effective rate of the protection is equal to VA star minus VA divided by VA. VA is the amount of domestic value added under free trade. VA star is the domestic value added after taking into account all tariffs on both final goods and intermediate inputs. Table 6.2 Nominal and effective rates of protection. You can see in this table, with no tariff, the price of laptop computer is $1,000. With 20% tariff on the final product, the price of same laptop computer is $1,200. And a 20% tariff plus a 50% tariff on imported inputs is equal to $1,200. Now value of the foreign inputs with no tariffs $600, with 20% tariff on the final product $600, with 20% tariff plus 50% tariff on imported inputs $900. Domestic value added with no tariff $400. A 20% tariff on the final product $600. Domestic value added on a 20% tariff plus 50% tariff on imported inputs negative 25% or $300. So you can see the effective rate of protection with no tariff is 0. With 20% tariff on final good is 50%. And with 20% tariff plus 50% tariff on imported inputs is negative 25%. Effective rates of protection are higher than nominal rates if intermediate inputs are imported tariff-free. If intermediate inputs are subject to tariffs, it reduces the effective rate of protection and can even turn it negative. Table 6.3 shows the Uruguay round. In Uruguay round, categories and the results. Tariffs. Most industrial product tariffs cut by 40%. Conversion of some agricultural quotas to tariffs. Subsidies. Subsidies defined. Classified prohibited and actionable subsidies. New agreements. Agreements on textiles and clothing, ATC. Trade-related aspects of intellectual property rights, TRIPS, TRIPS. Trade-related investment measure, TRIMS. General Agreement on Trade and Services, GATS. Institutional. Create the World Trade Organization, WTO. Refines the dispute settlement process. Implements periodic trade policy reviews. The Uruguay round included far more than tariff cuts. Analysis of quotas. Quota. A quantitative restriction that specifies a limit on the quantity of imports. Differences between quotas and tariffs. Tariffs limits imports by imposing a tax on them. Unlike tariffs, quotas do not generate tariff revenue for the government. Similarities between quotas and tariffs. Both lead to a reduction in imports, a fall in total domestic consumption, and an increase in domestic production. Types of quotas. Most transparent type of quota is an outright limitation on the quantity of imports, as for example, a limit on quantity of imports from country X, or a limit on quantity of imports from the rest of the world as a whole. Types and quotas continued. Import licensing requirements, forcing importers to obtain government licenses for their imports. Government regulates the number of licenses available. Types of quotas continued. Third type of quotas, voluntary export restraint, VER, or voluntary restraint agreement, VRA. The exporting country voluntarily agrees to limit its exports for a period. Types of quotas, VERS. VERS have similar effects as quotas. However, VERS are more popular as they do not require domestic legislative action, and they allow politicians to provide protection for domestic industry and to appear as proponents of free trade. The use of VERS increased with the decline in tariffs that results from the global trade rounds. However, recent international negotiations have restricted the use of VERS. The effect on the profits of foreign producers. The main difference between tariffs and quotas is that there is no government revenue from quotas. In place of tariff revenue, there are greater profits for foreign producers called quota rents. The effect on the profits of foreign producers continued. Two circumstances that can limit quota rents. If there is a large number of foreign producers, competition may limit their ability to increase prices. The government can extract the extra profits from foreign producers through an auction for import licenses. Figure 6.6, Analysis of Quota 1. Quota rents. Increased profits accruing foreign producers from the use of quotas take the place of tariff revenue. A quota restricts imports to line segments from Q1 to Q2 star and creates excess demand equal to Q2 star to Q2. The effect on profits of foreign producers continued. Second important difference between tariffs and quotas. Over time, as demand for the good increases and quota remains fixed, increase in consumer demand increase is the price paid by consumer, increase is the producer surplus garnered by domestic firms. In contrast, as increase in consumer demand for an item that has an import tariff increases the quantity of imports and leaves price intact. Figure 6.7 Analysis of Quota 2. In this figure, you can see the quota generates extra revenue for foreign producers shown by area C. In the case of tariff, the government earned revenue from imports. In the case of the quota, foreign producers receive extra profits. You can see if it would be tariff, this portion will be government's revenue. But in the quota, this portion is the profit for foreign producer. Hidden forms of the protection. Any trade barrier that reduces imports without imposing a tax has effects similar to those of a quota. Tariffs impose a tax. Non-tariff barriers, NTBs, quotas and non-tariff measures. Hidden forms of protection continued. Non-tariff measures are hidden, non-transparent forms of protection, such as excessively complicated customs procedures, environmental and consumer health and safety precautions, technical standards, government procurement rules, limits imposed by state trading companies. Intellectual property rights and trade. Intellectual property rights are usually provided into copyrights and related rights for literary and artistic work. Industrial property rights for trademarks, patents, industrial designs, geographical indications, layout of integrated circuits. Intellectual property rights and trade continued. There are rules for respecting intellectual property rights as they relate to trade. These rules were negotiated during the Uruguay Round from 1986 to 1994. With the trade-related aspects, intellectual property rights, we call it TRIPS agreement,